Hey there, welcome to my new options trading YouTube channel for trading vertical option spreads. My name is Eric, and today we're going to take a look at an earnings trade in NVDA. NVDA reports earnings tomorrow after the bell. So this is a trade I'm looking to get into tomorrow, and I'm going to explain why. I'm actually really excited to share this backtesting software that I've come across for options trading. It's pretty cool, and I'm going to show you, what I found for trading NVIDIA around earnings the last few years, and I'm going to put on a small trade, more of a test. I'm going to probably just do a single contract, but we'll talk a little bit about that in a minute. Before I forget, though, in this description of this video, I'm going to put a link for I updated a new spreadsheet with it's got about 38 stocks in it and ETFs that have really, really liquid options. So if you want to get a copy of a list of stocks to trade options on, this is a great starting point, and I'll send it over in an Excel format. That way you can just upload it into whatever platform you use. But again, check the description for that, and be sure to subscribe to the channel, because I'm really excited about some of these option back testing I've been able to do. I haven't found a software like this before. So let's go ahead and just look at the setup and talk about NVIDIA and just really trading earnings in general. And the general idea with earnings trades is that you never know what's going to happen, and you want to play the probabilities. But when it comes to trading options, selling options around earnings is really what most option traders do. It's not really a directional bet on which way the stock will go. It's more of a bet that after the earnings, the volatility is going to contract. And if the stock moves within the market maker move, then you can make pretty good money, and it's pretty consistent. Although there's never a complete winning strategy, so you always have to understand what you're risking for each trade. But what I want to share with you is just how NVIDIA has traded in this manner and why I'm going to put that trade on. Now, we'll talk about the risk and all that for your own, but this is what I'm looking to do. I'm only going to trade one, maybe a few contracts tomorrow, more of just kind of get into that realm of it. So before we go into the chart and all that stuff, I'm going to bring up, I took a screenshot from the software, and this is basically what the trade setup is. So some of these labels here we're not going to be concerned about too much, but basically this is the results for the last 3 years of basically selling a 25-15 put spread the day before earnings and buying it back the day after earnings. So a one-day or overnight type trade. NVIDIA trades after the bell, so we're going to want to put this. I'm going to want to put this trade on tomorrow at the very end of the day, and the numbers may change depending on what the stock trades tomorrow. But I'm going to put this trade on at the very end of the day. And then the very next day, I'm going to look to close that trade by the end of the day, and obviously, hopefully, for a profit. So again, it's a one-day trade. We're looking for a volatility crush and for the stock to stay within the market maker move. And we'll look at that in a minute. But had you done this the last 3 years for all the earnings, it had an 81% win rate. So that we had 9 wins, 2 losses. The average win was about $30. And the average loss was about $26. So the winners are definitely bigger than the losers. However, when we look at the risk of an actual contract, the risk per spread is actually much higher, which is kind of normal, and we'll look at that in a minute. But I just wanted to give you the general idea that this has been a very profitable strategy. Don't get too excited about this 48% returns. That's the return on the risk. And I don't want to get into too much of that, but I just want to show you the win rate and sort of the probability that this is going to be a winning trade. And this is pretty standard when you look at options trading. If you can get an 80% win rate, you're actually doing pretty well. Usually we base things around a 68%. That's the standard deviation stuff. And I don't want to get too technical, but so what we're going to look at, we're going to price out here is about selling the 25 delta put that expires this week on NVIDIA and buying the 50 delta put for expiration. And so in order to get the actual strikes, we need to go into the option chain. So let's go ahead and do that. Well, minimize that. Let's take a look at the option chain here. So I have NVIDIA. There's 4 days left. The volatility is super high. We're actually from a IV percentile, we're in the 68 range. And I have my delta here. So we're basically looking to sell the 25 delta, which in this case is the 96 put. Okay, it's trading for $1.90 or so, and we're looking to buy for protection because we don't want to go naked here. we want to buy for protection the delta 15. That was sort of the general idea for the back test. Obviously, there is a 15 here, 92. I think that's too wide for my purposes when I'm actually going to look at the 93. And just because it's a lower, not a lower price stock, but to take on the additional risk isn't worth the extra 10 cents or whatever. So I'm going to stick with the 96.93 put spread. And I'm going to come in here. I'm going to change this to a deep and wide 4-strike vertical. And I'm going to sell the 96. Right now it's saying the 96.94. I'm just going to drop this down because of the half strikes to the 93. So again, I'm looking to sell the 96 put and simultaneously buy the 93 put for protection. So this is a $3 spread, and I'm looking to get about 70 cents. Now, I'm not going to put this on until the end of the day tomorrow. So if NVIDIA were to rally, then the deltas are going to change and I would want to reset my strikes, or vice versa. If the stock sold off, I would probably end up selling something lower, or if the stock rallied, I would sell something higher. But in general, we're looking to sell. The main component here is to sell the 25 put, okay? And then you spread it off by buying the additional one for protection. So I'm looking to get like 70 cents. So let's just say this was the trade. This was the end of the day. With a $3 strike spread, you take the credit, which is 70 cents. So I'm trying to make $70, but I'm going to risk $230 because that's the difference between the spread and the credit. Okay, so $3 spread, $300 for the spread, and a 70-cent credit. So 300 minus 70 is 230. So I'm going to be risking $230 on this high probability trade to try to collect most of this. Now, are we going to get the whole thing? No, because we're going to close the trade the day after, which there would still be a couple days. But if we can sell it for 70 cents and we get a crush and buy it back for 10 cents or 20 cents or 5 cents or whatever, then we would be profitable. Also, if it goes against us and we start to lose money, we will also close the trade, because if we go back to the backtest picture, we saw, and I'll bring that back up in a minute, we saw that the winners were about the same or smaller than the losers. So we don't want to leave the trade on and risk $230. So again, the trade is to put this on at the end of the day, let earnings happen, and then buy it back the next day, regardless of what the stock does. That's the trade. That's what we're playing here, the back test, okay? So again, let me bring the picture back up here. So again, selling the 25 put, buying the 15 for protection, or the 18 or the 17, doesn't have to be perfect. And this has had a 9-win, 2-loss ratio, and the winners and losses have been, I'm just gonna call it relatively the same. Obviously, what we looked at, the 70 cents, there are some commissions. I included some basic commissions in this, and this is based on one spread here. So had you traded one spread and you made 9 trades for 31 bucks, you end up with a couple $100 here. So obviously you can trade more, but again, you got to understand the risk. There's always a risk with earnings. Do not, I plan on, if for some reason NVIDIA tanks, you're risking $230. Chances are you probably won't lose it all, but there is risk more than just this 26 bucks. So this is just a general idea of how this trade would go. So hopefully that helps. Oh, let me move that back in there, sorry. Hopefully that helps. I look forward to sharing more of these back tests with you guys. So make sure you subscribe and get the updates, and we'll see you at the next video.